Hi guys, thanks for tuning in to another episode of Nuggets News. Well, today's video is probably one of the most important I've ever done, and what I've stumbled across could be nothing or it could have profound implications, and I'd rather you be aware of it and prepared than be oblivious to all this and then the situation unfolds. So recently we saw the Reserve Bank of Australia, the RBA, come out and say that they're preparing the money printers, and this is something that I've been talking about for a long time now. The use of unconventional monetary tools to stimulate the economy and devalue the Aussie dollar to try and make us more competitive on the global stage. I share these sort of things on my personal Facebook and the Nuggets News Facebook page if you want to follow us and you don't have Twitter. So what we've seen lately is the Reserve Bank of Australia start to cut interest rates. So there's a long period from, back in 2016 where there was no change at all to interest rates. And then all of a sudden in June and July, we've had a couple of cuts back to back and then another one again recently in October. And a lot of people said, it'll never happen in Australia. We could never get low interest rates or negative. And yet here we are at 0.75 with only a couple more cuts to go until we're at that zero bound or even negative. And the RBA have spoken about that they don't necessarily want to take interest rates negative because it does weaken the banks, and I'll get into all that shortly as well. So if you followed our channel and you watched our documentary that I prepared over a year ago now, we released that at the start of the year. I said I think the RBA is going to be next to join the list of central banks that are printing money and increasing their balance sheets. Now, globally, central banks have said that they're going to, stop this and it's going to be temporary and whatnot, but I'll get into why I think it's all about to ramp up big time. So this is the article here where the Reserve Bank says that Philip Lowe is going to be doing a speech about unconventional monetary policy, lessons he's learned from overseas at a dinner on the 26th of November. So I'll keep you guys up to date whatever happens, but I think they're starting to test the waters for money printing and these other unconventional tools. So here we see the Australian Central Bank balance sheet, and despite us not technically doing QE, quantitative easing or money printing to give money to the banks, what we've seen is a big spike around the global financial crisis in 2008, and then it kind of tapered off. Now, Australia went through a real boom because of China, and watch our documentary if you want more information about how we dodged a bullet there. But since 2014, it's been pretty steadily increasing. Well, doubling, in fact, the amount of money the RBA has at a time when we didn't really do QE. So that balance sheet has been increasing just like all the other central banks when, officially Australia has never really started QE. So that in of itself is interesting. But the next thing I want to show you, simply astonished me. And to understand it, you need to understand the different types of money. So the first one's pretty easy to understand, M0. That's basically just coins and notes, physical money. Now that's stayed pretty steady around 112, 114 billion dollars over the past couple of years. But these days the majority of money is just digital, online, ones and zeros in a computer, and more people are realizing that money's not backed by anything these days other than the faith and trust of the local government for that regional currency. So M1 is the next step up in terms of the amount of money and the type of money. And this includes other things like demand deposits, travelers' checks, checkable deposits, negotiable orders. So you can think of this as the liquid portions of money, people that want to move money around from place to place rather than the stuff that's just sitting there, the numbers on the screen that never really moves and whatnot. The next broader definition and increase in supply of money is M2, and this includes a few other things, securities, mutual funds, term deposits, and then the broadest definition of all money that exists for each country and whatnot is those larger liquid assets. So think of the repo market, institutional money funds, everything that's denominated in Aussie dollars, and that's the broadest definition of money. But what is really shocking here is that M1. So a step up from just the physical notes and coins to the amount of deposits and money that people want to move around. And in July, we saw a huge uptick, $650 billion. And I don't know what's happened here. If you know that this is an error or a bug or something's happened, let me know. But why on earth have we had this huge increase out of the blue, hundreds of billions of dollars, in July? So what was happening back in July? I don't think this is a trend that's happened anywhere else. I've looked at the US, their M0 looks fairly accurate. hovering around the same mark. Their M1 hasn't really changed. It's stayed around 3,700, 3,900. They didn't have a huge increase like we did in Australia. So at the time, you'll remember the housing market was at its most fragile. We'd been correcting sharply for a number of years, and this is where there was a lot of fear in the media. Now, some people say that we're too negative on the housing market, but let's be honest, there was a lot of bad stuff happening at the time, and housing was unaffordable, and it had been coming back, and that move had been accelerating. So there's a lot of fear, a lot of nasty headlines in the Australian housing market. And if you looked at sentiment at the time, it was as bad as it's ever been. So the number of people that expect house prices to rise in the next 12 months from Martin North's data was at this all-time low. Nearly everyone thought that houses were going to keep going lower. So look, as a contrarian, maybe that's why we've been due for a bit of a bounce, and we have had a really strong rebound since then. But if the majority of the Australian public was really fearful that the Australian housing market was going to keep crashing, that was right around June, July. So did we have some sort of mini bank run that we weren't told about? And we know that banks only run fractional reserves these days. If you want more information on this, watch all the other videos I've done and my top 10 documentaries on economics and finance to get your head around these concepts. But banks only have fractional reserves between 10 and 20% of the actual money that is owed to people that you think that you've got there. So if anyone ever tries to get money out, that is the definition of a bank run. Now, these days we don't have literal bank runs with people lining up because the majority of people do banking online and it's all digital. So that's why we might not have seen an increase in cash and coins and whatnot move around. Now, in China, we know that it doesn't end well. They've seen these banks that are the fourth banks now that are collapsing, as we have seen bank runs as people actually do try to pull out cash. And that's why we are seeing even the Australian banks now, their profits are tumbling. They're weakening like we've seen in Europe. Those low interest rates environments compress the bank's margins, and the banks are teetering on the verge of collapse. Deutsche Bank, these European banks, because they've got negative interest rates. And now we're seeing, with interest rates being cut in Australia, the Aussie banks are beginning to weaken as well. With everything that we've heard about with the Royal Commission, the liar loans and whatnot, the Australian government, they literally need to do everything they can now to keep the housing market afloat. And I've had someone reach out to me who's in Josh Frydenberg's inner circle and obviously wants to remain anonymous. They had to contact me through encrypted apps and whatnot because everything they do and say is monitored. So he told me through a friend of a friend, and so take this with a grain of salt, that they've had emergency meetings about the economy and what is going on, and they're going to start to implement all these measures. The first one was obviously the 5% down deposit scheme. So these things are increasing the risk that individuals take on, young Australians, to get them in the market. But I think if things get nasty, we'll see $50,000, $100,000 first home owners grants. They're going to do everything they can to throw money into the Australian economy and housing market, because the alternative is the collapse of the housing market and the banks. And that is, that's going to be absolutely devastating. They don't want that to happen. So the other thing that is taking place is this war on cash. They don't want people to be able to withdraw large amounts of cash. We haven't even gone to negative interest rates yet, and we may have had this sort of mini panic, this mini bank run, which obviously the media didn't discuss. I haven't heard anyone talking about it. I'm not sure if I'm the only one to stumble upon this, and even if it is what happened, but that's definitely when we've seen all this war on cash and large payments and whatnot really heating up, and already talk about reducing that amount. At the same time, we saw a huge run up in the price of gold. It had been tracking sideways around $1,800, and then through June, July, August, up to $2,300. Obviously, we talked to our friends at Ainsley Bullion and Perth Mint, and there was huge demand from baby boomers and people looking to protect their wealth. And a lot of them were selling their investment properties, looking to go into cash and gold, protect their assets. And also for those of you that are interested in Bitcoin, we saw that huge run up in Aussie dollars from $20,000 we hit from the start of the year when Bitcoin was less than $5,000. So an enormous move. The Aussie dollar was getting beat up at that stage as well, as overseas investors and whatnot were saying, look, geez, the economy not looking good there. The Aussie dollar is really weak, and it dropped to about 66 cents. So all that was happening through June and July, and I don't know, maybe it's a coincidence, but I just think that something is going on there with a huge injection of money, possibly into the banks, to try and, add to their reserves if people are trying to withdraw cash put money into gold, Bitcoin, other things. Just get money out of the system. Let me know what you think below. So naturally, I think we're going to continue to see these sort of attacks against cryptocurrency, maybe against gold as well. Who knows? But they've got to implement these things to stop people being able to get money out of the banking system, because it will weaken it. So a lot of people say this will never happen in Australia, Nugget, negative interest rates. But do you think they thought that in Switzerland and Germany, some of the strongest economies, globally in Europe, but also globally, they've got negative interest rates there. So at the moment, the United States is, slightly higher than us, but I just think that this is spreading like a virus. Water finds its level, and you can't have high interest rates in one economy and not another. And that's why I've seen the US dollar strengthen at the moment, because all that money's flooding into the US trying to get high interest rates. So as we see here, let's dig into the balance sheets of all the major central banks around the world. Now, the US started to unwind their balance sheet and say, we're going to get things back to normal. And that didn't last long before markets had their big panic. And what we've seen recently is the Fed start to print money to the tune of hundreds of billions of dollars. And they're calling this, it's not QE. We're just, shoring up repo markets. And now we're just buying a few bonds again. But it's not QE, guys. Call it what you want. They've printed hundreds of billions of dollars. Now, some of the other central banks around the world, Europe, Japan, China, they haven't really even slowed down before they're going to have to start accelerating again. And this is where we get to the currency wars, where everyone wants their local currency lower to be more competitive with their exports and whatnot. So really nasty to see where this is all heading. And as you see, there's a pretty direct correlation between QE1, QE2, and QE3 when they were really ramping up money printing in 2012, 13, 14 there, and the stock market in red. So a really tight correlation to however much money you print, it basically ends up going into the stock market because the banks get it first. So Christine Lagarde has come out pretty openly recently and said that you should be happy to have your job rather than protect your savings. So she's basically saying that yes, they're probably going to have interest rates or deeply negative interest rates, and don't complain about it because you should just be happy to have your job. So I'm not sure when it became acceptable just to attack people that wanted to save money, but that's basically what central banks have decided now. That's their next, I guess, the next thing that they're going down, which is really, really crazy to say. So if we have a look at the US stock market here, you see it kind of had this double top here, and then it put its head above and broke out to new to all-time highs and then pulled back a little bit. And this is kind of where we are in Australia. But in 2012, 13, 14, once they ramped up that QE, stock markets absolutely boomed, and they've doubled since then when they started that QE, and they've been printing lots of money. So if we have a look at Australia, it's kind of a similar pattern here. We've got a double top from back in the financial crisis to now. We've peeped our head above new all-time highs and then pulled back. And we're at a crossroads where I think people are waiting to see if Australia is going to print money and give it to the banks like we've seen in the US and Europe. Now, naturally, the Australian economy isn't in the best place, and consumers are indebted. We're seeing lower growth. There's no wage growth and whatnot. So I think the natural path would be lower for stock markets to have a correction. But fundamentals are out the window these days, and valuations. This is the sort of stuff I've spoken about with Roger Montgomery in interviews. And it's not nice to say, it's not the right thing, but it's just the fact. And I think markets waiting to see if the central banks print money, there's every chance that our stock market could go into this, call it bubble, overvaluation, bull market, whatever you want. But I think that is where money is naturally going to flow if it follows what's happened, around the globe. The other thing where money's has really been absorbed is the bond market. So we see the yield on a 10-year bond, and similar to a high-interest savings account, you used to be able to get 5% risk-free. But as interest rates have got lower and lower, more and more people are desperate for whatever interest rate they can get. And in the US, we can still get 1-2% on a 10-year bond or a savings account. So again, that's why this money is flooding into the US and why the US dollar is getting stronger. Now in Australia, we've seen those interest rates get crushed from back in the 80s and 90s. We get 15% risk-free on an Australian government bond or a savings account. Now everyone obviously floods into that. It's pretty good. So now again, our yields are getting crushed down below 1% recently, and we're having this little bounce. But I think the natural, obviously, trend is lower here, and government bonds and interest rates in Australia are going to head negative because of our debt load. So tying this all together, if central banks are going to start printing money in Australia like they're now talking about, it's not going to get into small business. It is going to go into property and all the assets. So I think we could see the property bubble expand further. It's going to just make things unaffordable, and it is going to drive inequality because of things like the cancel-on effect. So what this is basically when you inject additional money, it increases the purchasing power in the parts of the economy where the money arrives first. Guess who gets that money first? The banks. So it changes their price structure, reallocates resources, and redistributes incomes. So a lot of people were fearful about inflation. If you print money, it's going to cause inflation. Well, not really, because it doesn't get into the real economy. It just lines the pockets of the bankers and all the asset prices. So I've done a video about this, how global debt created asset bubbles and inequality. I'll link to that at the end. But it's pretty clear that although everything's sort of going up on paper, compensation and wages have been pretty stagnant since all this has been happening. And we really see that the top percentiles are getting the huge gains and the rest of us are sort of falling behind comparatively. So that's what really worries me. I don't really care if the stock market, the bond market, and the housing market goes into this huge rally. It doesn't really matter if the average person is just falling further behind and inequality is getting greater and greater. And that's where I think we're going to see things like civil unrest as we've seen in other countries. Now, the other thing to worry about is if this does start to filter into the real economy, then we may get inflation. Or if central banks try new things like modern monetary theory or handing out money to people's QE to get the economy going, that's when we really risk inflation. And we've seen this in country after country. People are talking about the US having too many privileges as the world reserve currency. That's why they haven't really seen any of the pitfalls of this money creation. Whereas countries like Chile are joining the list of those to begin this inflationary spiral that's really hard to stop. And there's hundreds of currencies out there worth trillions of dollars, and their fate is inevitable. They're all going to lose their purchasing power. It just mathematically happens over time. So more people are going to choose hard assets, gold and Bitcoin and anything with a finite supply. So this is the list of countries by inflation. So many countries with super high inflation rates, they're just losing purchasing power. As you see, the market cap of gold and Bitcoin, they're relatively tiny, but there's just hundreds of these currencies with these big market caps where people are going to be able to choose to put their money in gold or Bitcoin as long as they've got access to, a basic smartphone or whatnot, education about all this stuff. Or even just necessity. If you see hyperinflation in your local country, that's why we've seen people turning to gold and Bitcoin or whatnot. So look, with gold at a $7 trillion market cap, recently it's gone up about 20% in price, but that means it's got to have around, $1 trillion or $2 trillion flow into it to go up that much because of how big the market cap already is. Whereas with something like Bitcoin at around $200 billion market cap, if $1 or $2 trillion goes into that, then that is a 10-fold, 20-fold increase, and Bitcoin goes to around a $100,000 Bitcoin price. So look, obviously that's why I'm so bullish on Bitcoin and gold, medium to long term. Anything can really happen in the short term, guys. But let me know what you think below. Is there a secret bailout? Did something happen in Australia? A mini bank run? Has the RBA been continuing to print money secretly and the media hasn't been telling us? If you think this is important, please share it with friends and family. Like this video, subscribe if you haven't already. If you want more information about anything we do, head to nuggetsnews.com.au and I'll talk to you again soon. Cheers.